Hi, everyone. Thanks for joining my course of Venture Analyst. It's been the course which I've been running for a couple of years, and more than 7,000 people participated in it. I hope you will find it useful. It will take us 4 or 5 weeks to go through the curriculum, and I hope that after that you will have enough knowledge to make investment decisions, and you will better understand how VC works, what VC wants when they make decisions about investing in startups. Today we will talk about what is venture capital, how it works, how is it different from business angel investments, and we will talk a little bit about the VC ecosystem in general, startup ecosystem in general. We will talk about the statistics in various countries, and I will also give some recommendations for startups as well. It will take us about 2 hours today to complete this lecture. I hope you will enjoy it. So let's start. A couple of words about myself. I work for the US venture capital TBF Global Ventures. I've been in this business for almost 10 years. I have also experience of starting and failing a startup when I was like very young. Speaking of my expertise, I spend a lot of time looking into startups which transform traditional industries with a stack of frontier technologies, including aerospace. I have an aerospace engineering degree myself, and I have also a master's degree in corporate finances. Let's jump into our today's topic. First of all, a disclaimer here. Everything, all the content and all the ideas and all the insights I give here, I give on behalf of myself, Denis Kalishkin, not on behalf of I2BF Global Ventures. We'll start from this picture because I like science fiction, and here are the pictures of cartoons and movies which I liked when I was a kid. And thanks to startups and thanks to investors which back them, we actually can find companies which are doing the solutions like that. But when we talk about the future, and personally myself, I joined venture capital because I wanted to impact the future, and I wanted to invest in companies which transform, which employ technologies and change everyday life of ordinary people. So when we talk about the future, you need to remember that it's not like distribute it's distributed not evenly across the globe and in various industries, and even in various departments on the different companies. This is a pretty old graph by McKinsey, but what it shows is on the in the rows you see various verticals. In the columns you see the departments in the corporations, and the colors of the cells show like the penetration of IT technologies in those departments and in those industries. Of course, this graph was done like 5 or 7 years ago, so probably now we will see more green cells in this picture. Nonetheless, what I want to show you is that even if you're working for an IT company and you have like 10 SaaS solutions and use machine learning for various applications, it's not the case for all of the other industries. And I have have a lot of experience investing in legacy, traditional, outdated industries like construction, manufacturing, logistics. And the penetration of technologies is very different in those verticals. So this is important to remember when you, as a venture capitalist or business angel, invest in various verticals. The other thing I would like to talk today is the term of disruptive innovations. So this is actually the term which makes nervous many corporations across the globe. For example, traditional banking and telecom companies, and this is something which makes those corporates to open innovation labs, corporate venture funds, and other ways of working with startups or acquiring startups. The reason for that is that you can, so for example, you can use some technology to build your business. And at the moment when you start a business, the technology sometimes could even be like look like it's lagging behind, or it couldn't take a lion's share of the market. But because of intrinsic its intrinsic ability to change the market, it makes the traditional companies go out of business. Like, for example, it happened with Kodak and digital images. So disrupt. But when people think about startups and think about disruptive innovations, people typically think that the technology of a startup or the technology of disruptive company is better than the existing technology of existing companies. But in reality, it's not always the case. And in many cases, actually, the disruptive innovations and disruptive technologies are applied for some niche markets, which are too small for traditional, for existing players to start, for existing players. They are not that interesting. But over the time, the technology improves and it starts to attack the existing market. For example, electric cars, which is now like kind of a hot topic, they have been on the market for more than 100 years. And the first electric cars were actually the trams. But it took a while to improve the to improve the technology and to become good enough to use them for electric cars, which are displaced in traditional cars. And the second example I read in a book, in one of the books about the disruptive technology, is the history of flash drives. So initially they were very pricey for using them in computers, and they were first used for cardio simulators. But later, when the technology was improved and became more cost efficient, it became widely spread. And I am old enough to remember the times when having a flash drive was a luxury, and very few people very few people use that. And now it's kind of technology which you can purchase in any store. And there are, of course, very many technologies which are in the position of a disruptive technology. for example, quantum computing, artificial intelligence, for example, like NLP technologies and LLMs are very popular these days. There are also other technologies like robotics and many technologies in biopharma and I hope in space tech, which will disrupt many industries in the coming decade. And I hope that you, if you become VCs or entrepreneurs, will be part of this journey. And one of the things, during my career, since I looked into many enterprise solutions, which are typically applied by corporates, I've seen the corporates being nervous and about the situation of being out of business, and there is a notion like you either disrupt your markets yourself, or you will be disrupted. And I see that many corporates nowadays they either they either adopt the technologies themselves, or adopt them through acquisition of startups. And this is one of the main drivers of the development of the markets. I'll show you the statistics below, but more than 80% of the company startups, they are acquired by corporates. So before we start, we need to make a definition. So what is a startup? Startup is a temporary, according to Steve Blank, is a temporary organization designed to search for repeatable and scalable business model. So when we talk about a scalable business model, we mean that the company will be growing like every day, every year will be doubling or tripling their revenue until they reach the company reaches at least $100 million in annual revenue. So it's really also important that the startup is reinventing the business model. Here is an example. For example, you would like to open a chain of coffee shops using a franchise. You can grow aggressively and doubling and tripling your revenue, but it wouldn't be a startup because you use the business model. You outsource this business model from your franchisor, and the intrinsic ability of this business model to become a very profitable and a business is lower than the business model than the business models of a startup. But for example, in developing countries, if you're doing a solution, an IT solution or a mail-driven solution for coffee shops, that could be a good idea for a startup. Okay, so we defined what is startup. Let's talk about what is venture capital and how this investment process looks like. Venture capital is actually a private equity fund which specifically invests in startups. And oftentimes, when I talk to entrepreneurs, especially from developing countries, they ask, "What will happen if I fail a startup and go bankrupt?" And you need to know that venture capital is built for that. So we intentionally, especially at the earlier stages, we intentionally invest, and we suggest that probably 30% of our companies will go bankrupt. 30% of the companies will be so-called zombie companies, so they dead alive, and they're not growing fast and not dying. And about 30% of the companies, 30% of the companies, they're they are growing significantly, and about 5 to 10% of the companies, they are the rock stars. So they could grow like 10x, 20x, 100x, like 10,000, 1,000x, so-called unicorns. And typically, those outlier companies, they make the majority of the return of the fund. So in a sense, venture capital is the business of looking for those outliers. So whenever you make a decision, try to understand what's unique about the company and why this company could become an outlier, which produces this exceptional returns. So the other like prejudice I come across a lot is that people think that venture capitalists are some sort of like magicians. So we have some secret knowledge, the crystal ball of making the decisions. Of course, that's not true, and that typically when a VC makes a decision about a startup, we apply very pretty simple methods for assessing the startups, and we will talk about the things we'll look into in our next lecture in this course. But simply put, we typically use common sense on one hand, and so to be a VC, first of all, you need like be a very curious person and be reasonable. And the other thing which helps us a lot is that over our career, we see many deals, like thousands of deals, and we have this wide spectrum of the companies we saw helps us to like better to make decisions better. And the last but not the least, very few people think about it, but VC education is the most expensive education you can get, because you can't like take a course and become a professional. It's like this is the profession of like the apprentice. It takes some time to apprentice to look how the master works. So it will take you several years to work, to see many deals, to make decisions, to make mistakes, lose money, and finally become a professional. And the learning curve is pretty long, just because of the nature of the business, because it takes you several years to understand whether the investment was successful or it was a mistake. And because of that, typically people don't build a venture fund from scratch. So when someone wants to start a fund, the good idea is to hire at least one partner or a couple of people who worked in other funds, and make those costly decisions and costly errors working in those funds. So the other thing very few people know about is that this risk-reward curve. So venture capital is a private equity investment, and as with any investment, you have risks of potential loss, and you have expected annual returns you can get from those investments. So the economists know this curve. So the higher risk you take, the higher potential returns you get. And this is really important, because when you make a decision in investing in startup, you have a temptation to de-risk the deal. So to decrease all the risks you can identify, but if you don't take enough risks, and if you see that like your risk card is like green in all aspects, it means that the returns, the potential returns you could get, will be also lower because of this curve. So keep it in mind. And one of the risks which we as SBC take is the business risk and the risk of the market growth. This is really important because, for example, if you look into like big existing markets like FMCG market, airline market, etc., they typically grow at very like moderate paces. While in contrast, for example, if you look at the quantum technology market, various niches of artificial intelligence markets, they are growing fast, like more than 10% of the year to year. Sometimes it could be 100% annually. But there is a big chance that you're for various reasons the market wouldn't like grow fast or wouldn't become huge as you initially planned. And this is one of the risks we as VC take, and keep this in mind when you make analysis of a startup looking into their total addressable market. So then when we talk about venture capital, there are so many players investing or supporting the startups. So I identified more than more than 15 potential players. So I'll tell you about them. So it all starts with friend, family, and fools investments. So it's typically the people you as a founder know, and they not necessarily are professional business angel investors. That would be like the people who know you personally and trust you. It's a very unstructured asset class, I would say, that the class of investors, just because you never know who could become such an investor. And then there are many crowdfunding platforms. They were extremely popular, especially when I was when I started working in venture capital. But they are mostly focused on B2C startups, and they are not the source of investment, but it's more the way of testing the demand, the way of getting the first pre-orders for your B2C products. Then the first, institutional, let's say, investors are angel investors or angel investment syndicates. And there are many angel groups or business angels, serial business angels who are doing it professionally on a regular basis. And some of them even use such platforms like co-investments platforms like AngelList or Our Crowd in Israel, and some other platforms. Then there are several types of ecosystem players which support startups at early stages. It all starts with incubators, business incubators, and the business incubators typically don't do investments, but they provide some additional services which could help entrepreneurs at the very early stage, probably when the entrepreneur doesn't even have an idea or a team. And in business incubators, it's actually one of the oldest business models. So far as I remember, it started like in 50s or 60s. The other business model, which becomes more popular lately, is venture studios or venture builders. Those companies have a more hands-on approach than business incubators and accelerators, and they have in-house teams which help entrepreneurs to build a business, because for example, they can have an IT team to build an MVP, and these business models were extremely successful in in the pharma sector, and they are becoming more popular lately. But how it works? If you're an entrepreneur, you join a venture studio. Venture studio acquires a pretty significant share of the company, gives you like small incremental investments, but it becomes a co-investor. It is kind of a syndicate co-founder, which supports your company like during your first year or year and a half, and helps you build the MVP, get the first sales, get the first industry partners, and increases the survival of a startup. It's a pretty interesting business model, and it started, so far as I remember, in the 90s. But we shall see how it will play out in the long run. The other thing you need to understand about venture studios is that a venture studio can't produce more than 10 companies per year. It's a very operational business model. The more scalable business model is accelerators, and there are two types of accelerators, like financial accelerators and corporate accelerators. So what's the accelerators, unlike venture studios and incubators, they work with existing startups. So like the startups apply for the current batch. They select like from several dozens to several hundreds of companies, and then they provide provide the acceleration program, which are typically from 3 to 6 months long, provide access to their network, and provide access to the investors. So it's kind of like a sprint, which helps entrepreneurs to increase, to increase sales, and to get some other flags which increase the probability of success of a startup. Financial accelerators typically take a share in a company for incremental investments, for example, I don't know, for $100,000, maybe $300,000. And the main idea for accelerators is that thanks to this acceleration program, they can increase the chances of the startup to raise money after the program, and increase their returns. One thing many entrepreneurs forget is that acceleration programs, accelerators, they also don't know the future. And even good accelerators like Y Combinator, they invest in companies, and a big portion of them will those companies will also fail. So if you're a part of acceleration program, it's not guaranteed that you will raise money after the acceleration program, and that the company won't go bankrupt. The corporate accelerators typically don't take shares in the companies, and the main stakeholder for the program program managers are the corporations which want to work with startups. So the main purpose of those acceleration programs is to start, like selling to a corporate, building an MVP, or developing a technology which which the corporation is very interested in having. Then after accelerators, startups typically raise money from early stage investors, and venture capitalists, they are actually very different, and the difference depends on the stage the venture capital invest in, because there are funds which invest at seed stages, Series A's, Series B's, and so on. And there are also scouting funds. This is typically more like customer acquisition cost type venture capital, rather than the venture capital which brings huge returns to the venture capital. And big funds typically use scouting funds to invest $50,000 to $100,000 along with the business angels, and they do that to have access to the deal, and just to have the ability to invest in the startup at the later stage. There are also many Series A, Series B, so-called growth stage funds. And those types of investors, they invest from, like, I don't know, tens of thousands of dollars to tens of millions of dollars to hundreds of millions of dollars. And those VCs are more like private equity investors rather than the early stage investors. And the late stage investors are more financially driven when they make their decisions. Then at later stages, there are also so-called venture debt funds. So it's not venture debt. It is not a convertible note or safe note, which we will talk in our future lectures. Venture debt is a debt, is a repayable debt which a startup can get to grow the business, and typically it's co-invested along with equity investment from a VC. Venture debts have been pretty popular lately, and still there are quite many companies and quite many business models where still startups raise venture debt investments. And along with pure financial investors, there are many corporate venture funds. And the main idea for corporate VCs is not only to get the returns, and sometimes they even don't don't want to, don't aim to get exceptional returns. They are more focused on getting some additional value for the corporates, either getting early access to the technology, or acquiring the company at some stage. And corporate VCs are a pretty big class of assets. Probably between around 20% of the market are especially at later stages, are raised from corporate VCs. Then there are family offices. These are like the players of high net worth individuals, which manage money of high net worth individuals, and they typically invest in many asset classes, including venture capital. Both investing as LPs and making direct investments in companies. And after the pandemics, or even prior to the pandemics, private equity funds have become very active in investing in startups as well. Now we see that many private equity funds are leaving the market, but still like pretty significant part of the investments which is done on the market is done by private equity funds. There is also an asset class of secondaries, and there are even specific funds which acquire shares of early investors and employees in unicorns or the companies which got a lot of funding. And of course, there is a different beast of crypto startups. And initially, it was called ICO. I don't remember how it was called exactly, but there is a new way of getting funding for Web3 startups. And of course, there are other types of ecosystem players, funds of funds, government organizations which support startups, financially with grants or non-financially in many ways. Now let's talk about the stages of the companies and how the companies look like at these stages. So suppose you're doing a deep tech company. So this is the company which has some technology, and it takes some time to make a research and development before you can monetize it. So, for example, if you're doing something in a lab and you expect that it will take you several years, up to 10 years, to develop, to test the feasibility of something, and you are now a team of engineers, then probably you shouldn't get VC funding. Instead, you'd better focus on government grants, which will enable you to complete your research until the stage you can make a spin-off and build a company. If you're doing a business, if you're at the stage when the technology barriers are solvable, but your product is not on the market, you probably can get it to the market within the next couple of years, and you still don't understand clearly, the product, the market niche you will be attacking, then the best choice for you at this stage would be to join some incubation program where you can polish your startup and polish your vision and find the co-founders, for example. There are also pretty cool acceleration programs, Antler and Entrepreneur First, which are focused exactly at this stage. So if you're if you're planning to launch a startup, but you don't have an idea and you don't have a and you don't have a co-founder, you can check out those acceleration programs. And by the way, I have also a separate course. It's more like a mentorship program where I help people to start to find an idea for startup and start a startup. So if you're curious about this program, just ping me and I'll tell you the details. So if you're already have an MVP, probably first sales like several $1,000s a month, or your product is not on the market, but you're plan to launch it within the next months, a couple of months, This is a good stage to approach either angel investors or join some acceleration program. And if your startup is on the market, I don't know, from 6 months to a year, you have some sort of a product. It couldn't be perfect, but you have some paying customers. For example, you have a positive unit economics. So this is the best time to approach venture capitalists and get your first seed funding. So you see that venture capitalists are like the fourth type of investors, which you approach after you have like brilliant idea for your startup. And there is also a separate thread for deep tech startups. And there is a good interview with Y Combinator partner. So go and check out the link I show here. So here I wanted to show you the difference between angel and pre-seed investment and seed investment in the United States. For example, if you're at the angel stage, you either don't have first sales or have like minimal sales, sometimes have an idea, but in most of the cases, you have at least MVP. Your startup is on the market for less than 2 years, typically less than a year, and the team is between 1 and 10 people, but typically it's 2, 3, 5 people. And the typical round size at this stages, even in the United States, is up to $1 million, probably from $50,000 to like $500,000. While in contrast, if we talk about seed stage investment, the startup has $200,000, $500,000 in annual revenue. Typically have at least beta or commercial version of the product. Then startup typically operates for 1 to 3 years, and the team is around 10 to 15 people. And the typical round size would be like between $1.5 million, probably $2 or $3 million, depending on how good is the team and how good is how good is the market. So the other thing you need to remember is that any investment, to raise any investment, takes time. And typically it takes, even in the United States, it could take up to 6 months from your first contacts with the first with the first investor till you close the round. And the other important thing is depending on the size of the investment and the stage of the company, you use various types of legal documents to close those investments. So if we talk about business angel round, seed round, or so-called bridge rounds, then you either use safe notes or convertible notes. So one important thing, we will talk about those types in details. But one thing to understand is that convertible note or safe note investments is like several page document, pretty standardized, especially if it's a safe note. And one important thing is that you don't negotiate the valuation, and you don't actually get the share in the company because this is an early stage, and it's really hard to make a reasonable judgment about the valuation of the company at this stage. But there are some other terms like maturity date for convertible note, like the market cap for the note, and some other things which help VCs to like to get an idea of the future equity they could get in a company. While in contrast, when we talk about the equity rounds like Series A, Series B, and so on, you acquire preferred shares, you sign the shareholder agreement, which is prepared with experienced and pretty costly lawyers. And typically it's more than 50-page document and a lot of terms which you need to negotiate. And for this reason, you employ this type of investment in those cases when like the investment size is pretty significant and the company is more mature, because it's just really costly to do that, and you need you know you need many terms to discuss and to negotiate with the entrepreneur. So again, as I said, it takes time to raise money, and suppose you have a brilliant idea for a startup, and this is the day one of your startup. So before you start talking to the investors, you can, of course, you can talk to business angels and venture capitalists at this stage, but the first thing you need to do is test your hypothesis with the clients. Probably get a few funding from friends, friends and family, and build an MVP, get your first revenue, and it will take you probably 6 months or so to go through this stage. Then, if you need funding, in most of the cases, you will go after the business angels, and it could take you like up to 6 months to close this round. So this is how your first year of the startup could go. Then the other thing entrepreneurs typically don't understand that to raise the next investment round will also take them up to 6 months. And to raise the next investment round, you will need to get like a significant progress. And before the market correction, it was like a common notion on the market that you need to have like you will raise the next investment round in 12 to 18 months. Now it's more preferable to have a runway for 24 months, so for 2 years. But anyway, you will be the last 6 months of this runway. You will be talking to investors, and one of the mistakes I see a lot of entrepreneurs at early stages do is they go to business angels and say, we will raise money, and this money will be sufficient to support us from 3 to 6 months. But in reality, what they say to their investors is that after this 3 to 6 months, we'll come to you and get additional money, additional funding, just because it's very unlikely that that new investors from the market will back us. So I strongly encourage you either increase the investment, the size of the investment which you raise, but it's not always possible, or revisit your cost structure to increase this runway for to 12 months and 18 months. Then, when we talk about raising money, it's actually a B2B sales, and not many people understand that. And with any B2B sales, you have a funnel, and various sources of deals have various conversions. For example, I'll show you, the examples of the conversions in a minute. But in the green zone, typically the sources of startups which provide a high level of filtration of the deals. For example, a pretty good source of startups for any VC is coming through existing founders, which we already invested in, or ex-employees of the startups which we backed. And for example, at HBF, if any of the employees of our existing portfolio company starts the business, we at least try to talk to those people. Why is that? Because first of all, we have relationships with entrepreneurs, and they, by we, I mean any VC has a relationship with their existing founders, and those founders, before they make an introduction, they make sure that this is a meaningful introduction. So this is why VCs typically pay a lot of attention to this sales channel, to this channel of deals. And if you're a startup, you can, ask your friends, co-founders who could potentially introduce you to their existing VCs. The other source of good source, high quality source of deals is other VCs and other business angels, which especially co-invest with you. For example, they're in the process of closing a deal, and they make an introduction and say, would you like to join the deal? Or if it's a business angel, for example, they invested in a company at their previous stage, and now their startup is raising money, and they approach you and introduce you to a deal. And the other high quality source of deals is accelerators, top accelerators, incubators, and some other ecosystem players. And the reason for that is before they get some startups in their acceleration program, they have pretty intense filtering. For example, so far as I remember, Y Combinator takes only 0.5% of the companies in their batches from all the companies which applied to their page. So very low acceptance rate, and they had very huge barrier to entry, and because of that, VCs pay a lot of attention to such filters. In the yellow zone, I would say these are proactive, outgoing, outbound contacts of VCs with startups. For example, VCs visit some events, demo day, pitch competitions, or some other or look into some startup ratings, as well as parse various startup bases like Crunchbase, PitchBook, or LinkedIn profiles, and identify some short list of the deals of the companies which they would like to talk to and which they proactively reach out to. Then in the orange zone, there are like some various newsletters, startup ratings, or inbound email and LinkedIn communication from startups, just because the signal noise in this case very low, and essentially anyone could shoot an email to a VC. And there is a very controversial source of deals. There are consultants and finders who help startups to raise money. Some of them are high quality professionals, but many of them, they're just subscribe a contract with you, and then start contacting to potential investors through LinkedIn and emails. So you can do it yourself. Here are a couple of examples of the deal flow conversions. For example, a while ago, I've been working on Series A deals in Industry 4.0 segment, and I used a wide spectrum of sources of the deals, like visiting industry events, sending outbound emails, looking into various ratings, getting personal referrals from other VCs and business angels. So, and out of 130 meetings, I closed one deal. Another example of my friend who is a business angel and invests in Business Angel Syndicate. He invests only in the startups which are backed by one of his friends. So, for example, someone in the syndicate has screened many startups and decided to invest in one of them. Then he introduces this startup to my friend, and he talks to the startup and makes an investment decision. So the conversion rate in this case is like around 20%. So every fifth deal is closed by him. So why is that? Because in the second case, the startups had come, there was a very intense filtering of the startups which were introduced to the person. So when you think about the deal flow how much time you need to spend to close the deal, think about those conversions and the reasons why those conversions could be higher or lower in your case. So if you're a startup founder, you need to understand what actually VCs are looking for when they talk to startups. First of all, there are two types of the VCs. Some of them are generalist VCs, so essentially they invest in horizontally in all business models. Some of the VCs are vertical VCs. For example, we at I2BF have a focus in vertical SaaS solutions. But anyway, every VC has an investment mandate and investment focus. At least this investment focus is in terms of the stages. And in most of the cases, VCs invest in specific geographies. For example, someone invests in Europe, someone invests in the United States. In many cases, people invest in various focus, have a specific focus in terms of the technology stack and in terms of the business models. For example, someone invests in marketplaces, others invest in deep tech, space tech, and so on. Why it's important is because first of all, why VCs do that? Because you can't be a professional in everything, and you need to somehow to narrow down the deal flow you're getting. And for startups, it's important to know that the investment mandate, just because it will increase the chances of you to close the deal. Because sometimes I see founders sending contacting investors out of the blue, for example, I don't know, sending a pharma deal to the fund which invests in B2B SaaS. So it's essentially useless to contact such investors just because they have the limitation in terms of their investment focus. Then there is also various funds look at various have some specific requirements in terms of financial traction. For example, if it's seed stage B2B SaaS fund in the United States, typically VC would like to see a startup with an MRR of more than $30,000, maybe $20,000, maybe $50,000. If it's a Series A, like VCs would like to see like between $100 and $150,000 in monthly recurring revenue. And it's for the founders, it's really important to know this, just because to calibrate what type of investors and like what type of traction do you need to have to raise a certain amount of money, and at what stage you'd better to approach these or those investors. Then a very important topic, especially for the startups outside the US, is that they especially in developing countries, is that they need to have a healthy cap table. I've seen many startups which raised like $100,000 or $500,000 and granted investors like 50% or 70% of their company. And this becomes a barrier to your next investment, just because the dilution will be very high. And when you raise business angel investments, you typically grant from 5 to 15% of your company. So make sure that if you're doing like a business angel investment now, make sure that you're not granting a very big share to your investors. And last but not the least, but startups from developing countries, in many cases, would need to have global ambitions. At least they need to have. The reason for that is that for many countries, their local markets are very small, and the exit opportunities are very small, so that they can't raise money from existing from the local investors, and to raise money from international investors, they need to show the traction outside of their countries. So keep this in mind when if you're like in any African countries or in any small countries like in MENA region, because it's oftentimes a limitation. So when we talk about the VC investment process, it looks like that. First, you do a first meeting. It's typically between 30 minutes and 1 hour. After the first meeting, VC typically send like Q&As, getting access to your data room, send you Q&A sessions, and complete the so-called business due diligence. If after this questions and business due diligence, the deal looks fine, then they start negotiate the deal terms, and negotiate the term sheet, and prepare investment memorandum. Then we have an investment committee, and after this investment committee, they have a due diligence process when they hire formal legal and in some cases financial professionals which do this due diligence. And it typically, for example, if it's a $2 million round, VC typically pays around $30,000 for such a due diligence. So it's a costly operation. It could take you a month. In some cases, it could take you longer. But what's important at this stage, VCs are really serious about closing the deal. And at this stage, you sign a term sheet, and you have some exclusivity period when you stop talking to other investors. And then after due diligence, if everything's fine, the investors are closing the deal. One important thing about disclosing the deal is to understand how VC legal structure looks like. Unlike other funds, private equity funds, venture capital doesn't have the money on their bank account when they invest in a startup. And to get those funding, they need to have some so-called capital calls. Why is that? Because a typical fund works in classical LP-GP structure. It means that every fund, every venture capital has some like legal entity where they get money from limited partners and wire those money to the startups, but they don't have this money. They don't have this money. All the money which LPs committed on the bank account, and they get those money like on a regular basis, like when they're closing a deal, or when they or like they get money, for example, on a quarterly, on a month or a monthly basis, according to some schedule. And this is important to understand because first of all, you oftentimes can hear about historical, dry powders, which VCs are managing now, but actually, you can easily remove this dry powder by signing, a side letter, and decreasing this dry powder like 2 or 3 times. So when we talk about the limited partners and the typical terms they have when they invest in a fund, so the typical lifespan for the fund is between 8 and 10 years. And the reason for that is it takes time to deploy capital, and it takes time for the companies to mature and got acquired. This lifespan is split into 2 periods. The first 3 to 5 years is the active investment phase, when a venture capital actively invests in new companies. And the remaining 5 to 7 years is the phase of maturing of the fund, when the VC could only make follow-on investments in their existing portfolio companies or sell in the companies. Why is that? Because you need some time. A startup needs some time, more than 5 years typically, to build the business and got acquired. And this is why those classical venture capital funds are structured that way. So when we talk about how the VC earns money, typically the fund has management fee like 2.5%, and the fund uses this management fee to pay salaries to the team. And but the majority of the returns for the fund are coming from so-called carried interests, and it's typically about 20%. When the carried interest is exceptional returns which you get for your LPs. For example, you have $100 million under management, and after you made all the investment decisions and sold all the companies, you got $300 million. So you've got to your limited partners $200 million returns, and you can take 20% of that returns as your carried interest, so around $40 million. Then there is a risk management. There is a risk management involved. You need to have like a pretty diversified portfolio. Typically, you need to have between 20 and 30, probably 40 deals in your portfolio, in a single fund, so that the portfolio was balanced. And this portfolio, you need to have a limit per deal, a limit per company, in order not to have a skewed portfolio. Typically, you can't invest more than 5 or 10% of the fund in a single company. And the last but not the least, when we see when limited partners sign up for some fund, they typically have an investment mandate in terms of the stage, in terms of the technology stack, in terms of geography, in terms of other. So investment mandate is actually the investment strategy which VC is signing up for when they plan to deploy the capital. So when we talk about limited partners, there are various types of source of the capital. First of all, high net worth individuals and family offices could be limited partners. Then some other VCs could also be limited partners in funds, just because they want to get access to the pipeline. Then insurance companies and especially pension funds are typical limited partners because these are one of the biggest asset managers globally. Then there are funds of funds, especially like in Europe. These are typically government funds which invest in other venture funds, venture capital, just to support their ecosystems. Sometimes those funds of funds they would like, for example, develop quantum computing technologies in their country, and they would grant money to the funds which are specifically focused on such technologies. Then there are purely government funds, not funds of funds which are deploying capital, but sometimes you can have the venture capital which have direct investments from some government funds which are like directly deploying the capital. Then it's not very widely spread, but sometimes you can find publicly traded venture capital funds. And of course, corporations are very big source of limited of the capital for venture capital, especially Asian corporations. They could both have the corporate funds and invest as LPs to purely financial investors. And there are also some specific types of investors like Army, FBI, CIA, and other specific agencies. They typically use venture capital as an instrument to get the access to some sort of technologies, or to support the developments of some sort of technologies they need for their own needs. So in terms of the types of venture capitals, there are also several types of structures. The most of the market works as a classical LPGP structure, which I talked a little bit earlier. But there are also some evergreen funds. Typically, these are family offices. What it means is that they don't have those capital calls. They don't have the formal structure, which leaves like of 8 to 10 years, they can they invest from the balance sheet, for example, if it's a corporation, or they can they can do like the deals whenever they like, and whenever they have some some extra capital on their on their bank account. And there are many like co-investment funds, rolling funds, and angel syndicates, which do investments through so-called SPVs, special purpose vehicles. So so typically they don't have like the funds under management, but they have this special purpose vehicle for a single deal. And what they do is that if they have good investments, they create a legal entity. They invest money to this single deal through this legal entity, and then they manage their position. For example, I saw some such deal by deal funds which are focused on specific batches of Y Combinators or Y Combinator alumni. Then you can ask a question. For example, I'm a high net worth individual, and why do I really need to invest as a like limited partner? Why not to create my own fund? In some cases, you can do that, but it's a very time-consuming task. For example, you would like to invest $1 million. You can invest this. You can invest it yourself, or you can provide this $1 million as an LP to, like, for example, a $30 million fund. So in case of the $30 million fund, the venture capital will invest in 20 companies or so, while if you invest alone, you will invest, I don't know, probably 5 to 10 deals, just because otherwise your investment check will be really small and you can't even get into the deal. Then based on the limit per company and the money you can deploy, in case of the venture capital investment as LP, you will be probably invest into seed and some to seed and seed plus stages, while if you invest on your own, you will be probably investing at pre-seed stages and taking more risks than if you invest as an LP. So it means, like, probably you will be getting more returns if you invest as LP versus investing on your own. Then if you invest if you're an LP to an existing fund, they will be deploying the capital in the companies in those geographies where they have access to the deals. While if you're doing it yourself, you will have the ability to invest either in the startups of your physical presence, or in the startups where you have some network, or you need to build this this network yourself, which takes time and money. And last but not the least, when you invest as an LP, you just kind of outsource this deal sourcing and pipeline building for someone who have already ecosystem. And in many cases, it could be more cost efficient. For example, you will be paying like 2% of the management fee annually, which is around $20,000. While if you will be deploying your capital on your own, you will need to build a team and pay this team around at least like $60,000. So depending on the investment size which you would like to deploy, investing as LP could be more viable versus building your own sales funnel and sales pipeline, fundraising pipeline. Yeah, and the last but not the least, I have already talked about the capital calls. So how it looks like. For example, we want to close a deal for $1 million, and we have several LPs, and we send them the letter saying, okay, we need to get $200,000, $300, and $500 proportionally to your commitments to our fund, because we are closing the deal. And it takes time, up to 2 weeks, to get those funding from the LPs and to wire those money to the startup. So when you invest in a startup as a VC, if finally you would like to sell the shares and get the returns and return money to investors. This event is called exit. There are several ways how you can sell your company, your shares in a company. The most successful startups become public, so they go through IPO to list their shares, and after lockup period, VC could sell the shares in the public market. But less than 10% of the companies go this way. So these are the most successful companies, even in the United States. The majority of startups got acquired by corporations, so more than 80% of the companies. But in many countries, in many developing countries, this IPO and M&A activity are not that widely spread, and sometimes entrepreneurs, sometimes investors employ either dividend model or management buyout model to get the exit. And of course, there is also the writing off of the company. So if it's a like zombie type company, or if it's got bankrupt, or the business didn't work out that well, and you have sold IP technology, but typically it's the loss for the fund, not like exceptional returns. So I have already told you that on one hand, investors would like to increase to take the risks, but on the other hand, they would like to decrease risk in some cases. And the first risk investors would like to improve is executional risk. So with all things equal, VCs would prefer to invest in second-time entrepreneurs, experienced CEOs, ex-VCs, and other like top-notch industry experts. So the people which they believe have the higher chances of succeeding in building business. The other significant risk, especially for deep tech companies, is technology risk. So it means that there are types of startups which which have significant technology risk, and they fail not because they can't build the business, but because they can't build the tech. And if your startup has high technology risks, investors would prefer improve your execution risk. So if you're doing a deep tech, investors would prefer to invest in second-time founders, for example. Then there is a risk of business model, and especially in developing countries, the business model of copycat is really popular. For example, you could see some business model like Alipay, for example, and make a copycat of this business model to Indonesia. Or you can see a business model working in one sector, for example, Uber, and you can make a copycat of this business model to the other industries, for example, building Uber for trucks. Why is that? Because to find a business model, you do kind of an research and development project, and if someone someone has already proved that this business model is working somewhere, then making a copycat of this business model decreases the risk decreases the risk of your failure. And there are some other things which could help you improve the chances of the startup to succeed. For example, for startups in developing countries, they can benefit from having their R&D centers in low-cost geographies. So they essentially need less funding to get the same results as, for example, companies in Silicon Valley. And with all things equal, VCs would also like to take a wait-and-see position because you can the more revenue traction a company has, the less risks you take. Okay, I wouldn't spend much time here. You can read it on later. Here are the examples of investment history and how the business started for top tech companies. And here are also a couple of examples for the taxi hailing services across the globe. You can see how many companies, how much money they raised, what's the current market cap, and how the team looked like when those startups were started. Now let's talk about the business angels and their relationships to the VCs. First of all, VCs always have the deal flow, which is too early for them to invest. And if you're a business angel and you have a friendly VC, you can get the access to this pipeline. They just will be sending you the deals just because they want to keep good relationships with the startup, but they can't invest at this stage. Then some VC partners also invest as business angels themselves. So you can, if you're a business angel and you have such a VC partner as a friend, have close relationships, you can just co-invest with them, co-invest with the investment professional who potentially could invest at the next stage of the next stage in this company. Then VCs have can share their expertise on the segment, and they also have access to various ecosystem players, starting from lawyers, and then they can advise. If you have access to if you have VCs in your network, they can introduce you to relevant people. And the last but not least, if you build a relationship with a VC, you can also introduce to them your portfolio companies which you backed as a business angel. Anyway, when you work with a VC, remember, help them do their main job, because a VC, venture capitalists, they are filtering ideas, startups, and if you help them to do this filtering better, like filtering out the bad deals, then you will be like you will have you will bring them additional value and improve the chances that you can build good relationships. So you can offer them your industry expertise, for example. You can refer them good startups, and you can no, and you can, and you're, as a business angel, for example, you naturally meet startups earlier before than any other VC, just because you operate at the stage when the startup you operate at the stage too early for the VC to contact the startups. So how you can build a relationship with the VC? First of all, you can invest as a limited partner to the VC, and in this case, you will get the regular reporting. You will get the opportunity to talk to the companies in their pipeline and their existing portfolio companies. Then you can meet other business angels and VCs at various events. But it's really important. But it's really important for you to build a good reputation and be helpful, so that you know, so that you could build good relationships. Then a really good idea is, if you co-invest with some VC, do a regular catch-ups with them, share your network, expertise, and pipeline, and whatever you do, you better clearly position yourself and position your added value. And actually, for example, if you're a C-level manager in a company and understand, for example, retail tech, that's a really that's a really big added value for the VCs, because you could be like an industry expert for them. And the last but not the least, if you have some relationship with people, don't burn them. Don't burn the contact. Use it wisely. Do the filtering. Yeah. So let's talk a little bit about various job positions in the VC. So it all starts from interns, then there are analysts, associates, investment directors, and managing partners. And there are different, trajectories how you could get to the VC. If you are a managing partner, you could either co-found the fund, and oftentimes you could be an startup founder, an investment banker, or you worked in other VCs, or you are a C-level manager in some tech company, or you had a traditional business and decided to start investing in startups. If you're an investment director or associate, you either was an analyst, or you worked, you had relevant expertise working for a corporation, consulting company, investment banking. Probably you was a founder or worked in other VC. And interns and analysts are the entry position. Typically, these are the people with no previous experience or relevant experience in VC. And the trajectories could be really different, but these are the types of the positions you could get after this course. Now I would like to give some recommendations for startup founders, especially for those who are in developing countries. First of all, as I said, there are many countries which have a really small market. For example, you live in one of those countries in the table above, and you would like to create a startup which charges any citizen of the country $10 a month. There are very few markets. There are very few products which you could charge like any citizen of the country. But suppose this is the case, and if you calculate the total addressable market, then in many countries, like the markets are really small. For example, like Estonia, Latvia, Israel, Singapore, Chile, they have the markets below than $1 billion or like $1 billion, very close to $1 billion. But in many countries, your local market is too small to build a big company. But there are some countries like Singapore, Estonia, Israel, Chile, which have a pretty significant local startup ecosystem. And the reason for that is that from day one, the startups in those geographies, they build the business for international for other countries. So if you live in a country with a small local market, think about from day one what would be the next market you would like to expand. And when people expand their to the local market, to the other markets, I've seen several strategies. The first strategy is like, I go to the Silicon Valley no matter what. And in many cases, it could be a good strategy, but in many cases, but you'd better follow your clients. For example, your clients could be in Texas or, I don't know, in New York. So be really wise about us. The other strategy is, which I hear a lot, is that startups say, okay, I would like to raise money from you now, and I will be building the next 12 months, I will spend building the product for the local market. And unfortunately, this strategy doesn't work really well in many cases, because first of all, when you build a product for your local market, in many cases, you will need to build from scratch the product for the new market. Because like the business process could be different, the client needs could be different, or you don't like the clients don't really need your product at the new market. The other problem is the longer like your competitors from, I don't know, from India, for example, or from the US, will be developing their products for these 12 months while you are developing your local product. So when you decide to expand to the new market, it could be occupied. So I strongly encourage you to expand to the other market, to the target market, the earlier the possible. So, but anyway, startup is a business, so act like a businessman. So when you choose a market, first of all, ask yourself, is this market big and attractive? Is it a perfect timing to enter this market? Then ask yourself, where your clients are located? And should you have an office next door? Because, for example, in many cases for B2C, for example, if you're doing a mobile app, you don't really need to have an office in a country. You can use Stripe to charge your clients, at least to some extent. Then think about if you could benefit from, cost savings, keeping your R&D in low-cost geography. And probably you can also benefit from some local, tax preferences and, government support programs, which are like focused on startups. Then ask yourself if you can find the necessary talent pool in your geography to build the business. For example, in some countries, it's really hard to find a good, digital marketing professional or product manager. Then, if you plan to expand to some market, ask yourself, do you have a relevant network there? And if no, which you could benefit from, and if not, how you plan to build this network? For example, you could participate in some acceleration program or become like a part of some ecosystem, which could give you the boost. And last but not the least, ask yourself, if you expand to some geography, do you will you be able to raise money there? Are there VCs which are investing in this geography? When you talk about when a startup founder talks with a VC, you need to know several stuff about them. First of all, as I said, you need to know their investment focus, just because to understand if it's like this is the relevant VC to talk to or not. Then you need to know what is the investment cycle, the stage of the investment cycle of a VC. You remember there is an active investment phase and there is a maturity investment phase. And if you're raising money, you would like to talk to the VCs which are in the next investment phase, just because they can make investments in new deals. And you also can ask them so you can how you can figure this out. You can either look at Crunchbase or PitchBook if they closed new deals over the last 12 months, or you can ask them directly during the call or meeting. Then during the meeting, you can ask the investment strategy of the fund. So do they do follow-on investments? How long do they plan to keep their position in your company? What added value they provide to the portfolio company? Because you need to plan your not only the investment, the current investment, but also like the next investment rounds, and you'd better to know if you are aligned with the VC. Then when you are serious about closing investment with someone as a startup founder, make double check on the reputation of the venture capital. So talk to some portfolio companies and talk to some people on the market if they know what reputation this VC has, because it's a long-term game, and you don't want to have problems along the way. And the last but not the least, when you talk with a VC, ask them about their investment process. How does it look like? How long does it take? How long does it take for them to make a decision? What are the next steps? What do they need on your end to make the next step, so that you understand the timing of closing the deal. Here are some mistakes I've seen entrepreneurs which have done. For example, I've seen a company which raised $1 million and grant in a single investment, and granted 51% of their company. And then they wanted to raise the next investment round, and it meant so that they will have 20 to 30% dilution. But in this case, they granted too much at the very early stage, and they had very big problems with closing the next round. They had to renegotiate the terms with their existing investors. So don't do that. The other problem I've seen, one startup granted 15% of their shares to their corporate lawyer. and the lawyer was not like co-founder and employee running the business, and they had a lot of they had many conversations with the potential VCs and with this lawyer in order to decrease the share, the ownership of this person. And the third case, the startup got a high pre-money valuation at the early stage, and the problem with that is when you have a high valuation, higher than the average on the market, very few investors want to invest in you. And at the next stage, you will need to increase this valuation, and even fewer investors would be like interested in investing in you. So I don't say that you need to make to sell your shares cheap, but be reasonable about the types of the deal you're closing. We will talk about the terms in one of our next lectures. So a few words about competition. When startups is a pretty like there are like millions of people are building startups across the globe. So if the timing is right for some business idea, there are probably 10 to 20 teams which are working on it at the same time. So that's okay to have direct competitors. The only thing you need to make sure that you're not competing against like Google or like some big corporation which holds the lion's share of the market, because it would be pretty hard to overcompete them. The ideal competitor landscape is like 2, 5, 10 companies at more or less the same stages, probably raised $1 or $2 or $5 million at the same time. Yeah, and it's still unclear who will be the winner on the market. The other question VCs typically ask is, what's your secret sauce? What is the barrier to entry? And the reason for them is actually is coming from microeconomics. It's not obvious, but from microeconomics, we know that perfect competition, companies on the markets with perfect competition have like zero net income. While if you're in the case of the monopoly, like the net income is maximal. And this is why if you're building a startup, you'd better focus on some niche and tailor-made solution for some small group, and then gradually expand your potential market size. Just because you're becoming a monopoly on some small niche, and you can charge like extra 10-20% for 20% premium, and like your clients would be happy to pay it, and this increases your like margins dramatically. Yeah, we'll talk about competitor analysis more, but here is how the VC startup founders typically do the competitor analysis slide. It's called the perception diagram, but it's it's typically not that informative. And when I do competitor analysis for investment memorandum, I typically do something like that, where on horizontal axis you can see in the rows you can see like a mix of business and technology parameters of a startup, and in the columns you see the startup, the direct competitors, and the market alternatives. Here are some sources of information you could get when you do analysis of a startup. I hope they will be helpful for you. And now it's the last section of our today's lecture. I would like to talk a little bit about VC statistics. So first of all, why there is so much buzz around startups, especially about software startups? If you look at the public companies, you can click on this report. But you know, software companies, public companies, had the biggest market capitalization growth compared to other industries. And if we look, so this is why VCs and other private investors, as well as governments, they really they pay a lot of attention to startups. There is also another aspect why governments are really interested in building startup ecosystems and support startup founders. There is a research which shows that there are only like less than 1% of firms in a country get VC funding, but they create 5 to 7% of the jobs, for example, in the United States. And this is not only jobs, but these are high quality jobs, like high quality human capital jobs. And they also created technologies the countries can benefit from. When we talk about startups and when we talk about small businesses, someone can say, okay, startup is a small business. But what is the difference? If you look at the if you look at the small business which don't get funding, it grows like linearly, gradually increasing their headcount. While if the company is backed by the VC, the headcount is growing much faster. But the revenue of those companies is growing even faster. So this is why startups are so attractive for governments, just because they create more jobs and they pay more taxes. So if we talk about the sizes of various startup ecosystems, still the United States is the biggest ecosystem globally. The other few big ecosystems are Europe and Asia. Singapore, Latin America, Africa, India are interesting, but still emerging startup ecosystems. So here is a little bit of statistics. United States is still 48% of the market in terms of the dollars invested, and more than 40% in terms of the numbers of deals done. So in many cases, if you're building a startup, at some point you will be expanding to the US market. Here's a little bit of statistics, what happened on the market during the last couple of years. So 2023 was the year with the minimum funding since 2018. But someone can think that it was a really significant drop, while like actually 2021 to 2022 were anomalies. We shall see how the 2024 will play out. But it's actually not that significant drop. And the situation was more dramatic during the dot-com crisis. So when the funding dropped 85%. If we talk about you know, how VC market operates during the crises, you can read, for example, the recommendations from Sequoia. It's called Black Swan Letter, which they wrote in 2020 during COVID lockdown. But it's actually more or less the same recommendations they gave during 2008. And it's also interesting to watch this webinar by Carta about how the LP acted during the lockdown period. So you can, it could give you an example, an idea of how LPs behave during the crises. So if we talk about the global VC market dynamics by stages, of course, in terms, if you look into the number of the deals, the pre-seed and seed stage deals are the biggest in terms of the number of the deals, while the majority of investments in terms of the dollar volume invested are coming from Series A plus deals. In terms of the technology stack, globally, software is still the biggest category. Around 40% of the companies are raising money for software and working in software. But there are some other niches which are pretty big, and for example, pharma, biotech and pharma is one of the biggest categories as well. And you all, of course, you have heard about the unicorns, but probably not all of you know that it's a pretty new phenomenon, because unicorns, unicorns, these are the companies with private companies with $1 billion plus valuation. They emerged only around 2009, and previously the companies went public before they marked like $1 billion valuation. And over the last decade, the number of the unicorns grew significantly. But even now, like the number of unicorns globally is more, probably like 1,500. And the other phenomenon associated with the unicorns is that initially the unicorns were born in the United States, but now there are more than 50 countries across the globe which have unicorns. So this phenomenon became global, especially during 2021, when like investors were investing at late stages like crazy. So if we talk about the exit, you remember I told you that the majority of the exits are done through M&As, as you can see on the graph on the left. While in terms of the returns and in terms of the size of the investments, the majority of this sales is coming from the public listings of the companies, just because the size of the deals during the public listing is higher than during the M&A, because like during the M&A, the company is typically the average size of the deal in the United States is around $100 million, while during the public listing it could be $1 billion or more. And then there is a little bit of statistics about other VC statistics in other geographies. For example, here is the statistics on the funding in European Union. Here is the statistics of the funding in Latin America. You can see that Brazil is the biggest market, and Mexico is the second biggest market, while the rest of the Latin America is just a fraction of the market. And you also see that the funding dropped dramatically during the last couple of years. Here is statistics from Africa. Pretty big market, around $6 billion invested in 2022 alone. And here is the statistics from India. Probably some of you are in the MENA region. Here is the statistics from the MENA region. And last but not the least, the country which, which is really small, but raises more than but the startups are raising, big funding rounds, and in 2021 raised more than $20 billion, almost $30 billion. This is crazy. But the majority of the local startups, they develop on the US market, and this is the main reason why they have such a huge local VC market. That's pretty it for today. Sorry the lecture was long this time, but I hope that you enjoyed it and got a lot of insights. Let's meet in a week. Have a great weekend.